Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is going to be the first in a series of articles where I'm going to go through all of the sectors and subsectors that are currently reported by FactSet, and I'm going to look for value in this overvalued market. The first sector that I'm going to be covering with this video is the commercial services sector. I will be looking at 6 companies that I screened out of 366 companies that actually were included in this sector. But before I get into the consumer services sector, I want to talk a little bit about the S&P 500 itself and the fact that we had a nice bear market really in December. If I shorten this graph a little bit here on the S&P 500, you can see that we did have, a pretty bad market the last quarter or so of 2018. But when you look at this S&P 500 graph, this orange line represents a PE of 15, this blue line a PE of 18. And that's kind of a range of what I would call fair value for the market, at least going back to 1999. And you can see when the market was really overvalued how poorly it performed. But you can also see how the price tends to track the earnings results, which is the orange line, and for that matter, the blue line, just at different multiples. This shows that the S&P actually cut the dividend coming out of the recession. But as I pointed out in the article, since 2014, the market had become really overvalued. And as a value investor, this was very troubling to me because I had a lot of trouble finding anything to invest in with market valuations this high. But just this little bit of correction has helped a lot, which I'll be covering in this series of articles. Now, I still see the market as being moderately overvalued, or at the best fully valued right now. So even though we've had this nice little correction, I don't think we see a market that's actually cheap yet, but there are stocks within the market that are. And I'll be covering 6 of those from the consumer services sector as reported by FactSet with this video. The first of the 6 research candidates I'm going to cover is Genpact Limited. It's a Bermuda organized company trading on the New York Stock Exchange. As you can see, this company just started paying a dividend. It yields currently 1%. It's trading at what I'll call a fully valued PE of 16. I would like to see it cheaper. But what this series of articles is about is look how the market value has come down thanks to that bear market activity we've seen throughout 2018. This stock specifically was pretty overvalued with a PE over 20 at the beginning of the year. And now we've come into the beginning of 2019 where the PE is trading at around a 16.4 blended PE ratio. I do want to point out that, it did get down to a 15 PE, and I would have called it attractively valued there. But there's another metric I want to look at all of these companies on. I also want to look at it, the multiple of EBITDA per share, or earnings before interest, taxes, depreciation, and amortization. And what you see here is you see a much higher correlation. Now, a couple things that I think are interesting that are kind of just general investment wisdom, at least from my perspective. This company went public in August of 2007, and like quite common with companies when they first go public, they come out with a lot of hype. This company is a very interesting company. It's in business process management, outsourcing, information outsourcing, and it's heavily involved in artificial intelligence, which of course is a hot item in today's world. But the stock came out very fully valued with a PE of 20, and then for the next year after the IPO, if you will, the company's stock price then reverted to the mean and actually became quite undervalued. And this would have been a great time to buy this stock. Had you bought this stock in November of 2008, when its price to EBITDA was under 8, and it's currently 12.3, you'd have averaged about almost a 14% annualized rate of return over that time frame. And keep in mind, that's almost all capital appreciation. Now, I'm also going to look at forecasting here. When you look at future EBITDA expectations, the company is expected to grow EBITDA at a average rate of about 17% over the next 2 years, 21% in this year, 2019, followed by 8%. And there are 7 analysts making that forecast. The longer-term trend line growth rate for EBITDA growth in this company is averaging about 10% future growth. So this company does have some growth potential, and it's currently trading at a valuation level that is within my valuation corridor but fully valued. The company only has 38% debt, and it actually has an excellent analyst scorecard. So when I'm reviewing these estimates by these analysts. What I want you to know here is when they were making a one-year forecast, they only missed it 11% of the time. They beat it 67% of the time. That's with a 10% margin of error. And the record was almost equally as good, 11% miss, we're on a 20% margin of error for the 2-year forward. But generally speaking, the analysts have got this company right. It's a stock I'd never looked at before. I'm not sure whether I'm ready to spend the time researching it not now, but if it gets a little cheaper, I might be. The next company in this group is Interpublic Group. It's a major advertising and marketing company. I do want you to look at this graph because I think it's quite interesting. You can see that the stock has a lot of cyclicality. It came out of the recession of 2001, which is depicted by this gray shaded area. It was extremely overvalued, which was during the irrational exuberant period. We had this period of horrible performance as the earnings of this company literally deteriorated year after year, turned quite negative for 3 years. And then we come into, interestingly enough, we come into the recession of 2008, and it has one of the best years it ever had. But then if I shorten this graph to coming out of the Great Recession, we see that the company's earnings growth has really been pretty good. It averaged over 23%, but that included a 147% growth rate into 2010. So I shorten that a little bit. Now I think you're getting kind of a picture of what this company is kind of capable of doing. Earnings growth has averaged 15%. It currently offers a 3.8% dividend yield, and it was actually reasonably valued in 2018. But now, thanks to the little bearish activity we've had recently, it's now become undervalued with a PE of 12.8 and a dividend yield of 3.8%. If I look at it again from the perspective of EBITDA and look at the earnings, or excuse me, the price correlation to EBITDA, you also will see a very nice correlation here and a little better numbers than we saw previously. But once again, I'm going to shorten the time frame, and you can see that EBITDA growth has averaged about 12.9%, and you can see that the price has tracked that very nicely. You have very obvious periods of overvaluation and various obvious periods of undervaluation. The company's dividend record has been excellent. Since the company started paying a dividend, they've grown their dividend by, on average, about 20% a year. You can see that it's gone from 24 cents to 30 to 38 and so on and so forth. When I look at the company going forward, the forecast for this company to continue growing at about 9.5% to 10%. But in this case, because the valuation is so low, that would apply some really, really high rates of return. If this company got back to a normal 9 times EBITDA valuation, it's currently trading at about 6.8 times EBITDA. So there's a lot of upside here if we get back to a normal price to EBITDA valuation. And once again, we see an analyst record that is good, but not quite as good as we saw with our previous example. The analysts on a 1-year forward have missed the estimates about a third of the time. On the 2-year, with a 20% margin of error, they've only missed it 22% of the time. But anyway, this is one of your larger advertising companies. It's been a very cyclical company historically, but since the recession of 2008, it's really put together a good record, and the stock does appear to be very inexpensive right now and also offers a big advantage of a nice dividend yield. The company's BBB rated with only 36% debt to capital. With my next research candidate, I'm going to look at Manpower Group, really an employment agency in this consumer services sector, if you will. I find this graph very, very interesting because it really shows how important business results are to shareholder values over time. You can see that the price has tracked the company's operating history very, very closely. Now, there's a lot of volatility in between with the stock price. You can see that it got pretty overvalued in 2017. And then now we've got a forecast of a negative growth rate of earnings in 2019, and we've seen this incredible collapse in stock price. You know, since January of 2018, the stock has, since January 31st of 2018, the stock has fallen almost 45%. I mean, that's really quite incredible. Now, if we take a look at it with EBITDA, we obviously see the same thing, but we see a little milder opportunity here. We don't see expectations for quite as big a drop. But the point I want to really make here is this company has gotten extremely cheap relative to its multiple of EBITDA. It only trades at 5.6 times EBITDA. when you look forward at what analysts are expecting, there are 9 analysts following this company, and I think this is part of the reason why the valuation is so low. They're not expecting much growth in EBITDA over the next couple of years. However, if it got back to a normal 8 times EBITDA, which I don't think is unreasonable at all, once again, you would have an opportunity to generate, almost 29% annualized rate of returns out to 2020. So, it's really a very undervalued stock at this point. Yields almost 3%, only has 13% debt, and is rated BBB. Once again, the analyst scorecard on this company is good. The analysts have only missed estimates by about 22% of the time. So, I think that simply just means that there's some credence that these estimates might be reasonable, but at such a low level, they could also be understating them also. This is one I think is worth looking at. My next company is Omnicom Group, one of the best known advertising agencies in the world. It's actually a holding company which owns several advertising agencies. And once again, you see this relationship between price and value, and you also see the importance of valuation when you look at this graph. You can see that, like a lot of companies, it was way overvalued, coming into 1999 and 2000, and that obviously led to very poor performance, even during a time when the business did extremely well. They kind of suffered a little bit in the recession. That brought them from being overvalued to being, significantly undervalued. The stock got overvalued in 2014, like I talked about with the S&P, but 2018 and 2017 actually both brought this stock back down to attractive valuation. Yields over 3%. It does have more debt than most of them, but it's also a BBB plus rated company. When I look at this company from a prospect of, price to EBITDA, once again, I see a very nice correlation. I see a lot of low valuation coming out of the Great Recession. It remains undervalued at this point. Forecasts are for growth of about 3%, again, not very high. And again, I think it's these low expectations which have created these low valuations. But from a value investor's point of view, low valuations are what can really give you a real boost in return, because if this company went back to its normal price to EBITDA of 9 or 10, somewhere in that range, anywhere in these ranges here, you have the opportunity to make a great deal of money over just the next couple of years. And the analyst scorecard, again, is very nice. They've beat over almost 90% of the time. They've beat analyst estimates. I think that's really important. That also tells me the company gives good guidance. So once again, you've got a really strong valuation play, but this company's been undervalued, I want you to notice, for the last couple of years, in contrast to what we saw with some of the other examples. My next research candidate is Publicis Group, a French company in the advertising space. Very interesting relationship between earnings and stock price here. Again, you see the IPO, the correction where, over the next year, the company got down at finally into attractive valuation. What I'm really saying there, my feelings of IPO have always been, I've never invested in the IPO, but I've bought young companies before, or companies that newly went public, but I usually waited till I could buy them at an attractive valuation. You could see you'd have been smart to wait till about September of 2001 to buy this company, but you see this constant revision to the mean, where you see these periods of overvaluation that lead to undervaluation. Of course, valuation is always exasperated by a recession. Once again, we come into 2018, we have a down year of earnings. The market punishes that very severely. Now, there's a lot of inconsistency in the dividend growth here. The company does offer a 3% dividend yield today, and if I looked at that just from a valuation perspective, the dividend yield right now is on the high side of what the company's ever been. That was through last year, and we've had just a little bit of a rally here, so the yield is now down to 3% instead of 4%. But again, a very interesting company from a standpoint of valuation based on operating earnings. Let's take a look at it from the point of view of valuation relative to EBITDA. Once again, we see the similar correlation here. The normal price to EBITDA has been about 8.6 times EBITDA. It's currently trading at 7.5. That makes it, look quite undervalued. And again, I want you to notice, you see these high periods of valuation are always going to lead to poor performance over the next period of time, 1, 2, 3, 4, 5 years. To me, this is always what I've always called an obvious mistake. When you see valuation levels like that, you should be forewarned that you're not going to see much. But once again, we don't see any expectations of growth. Rate of return is strictly going to be a function here of the company going back to a more normal valuation, which I would expect. The analyst scorecard on this stock is really excellent on a 1-year forecast and quite good on a 2-year forecast also. So here's an example of a company that analysts have gotten right, generally speaking. It looks extremely undervalued at price to EBITDA 7.5, offers a 3% dividend yield. And again, I would argue that these dividend fluctuations, I'm going to bet, and I haven't researched this thoroughly at this point, are probably currency related more than anything. My final research candidate in this consumer services sector is Wpp Plc. This is an American company. It's again another company that's an advertising and marketing services company, as you can see by the written portion. Once again, a very similar theme, a very poor 2018 with kind of moderate expectations going forward on earnings. Here we do have a nice 7% dividend yield, which is primarily a function not of dividend growth. Dividends actually expected to decrease this year, which I think is part of why we had this precipitous drop. But it's really because the stock price has fallen so much, which has really increased that yield. It only has 38% debt. It's BBB rated. Let's take a look at it from a standpoint of EBITDA real quick. When I look at price to EBIT, I see a very similar story. You can really see these periods of extreme valuations. I mean, it's just, to me, it's always so obvious when I look at graphs like this, how you can see, and yet most people are afraid to buy stocks when they're cheap like this. This stock is extremely cheap right now. Forecast, again, is for very little to no growth over the next couple of years. You know, it's negative growth for this year, followed by maybe 3.6 to 4% growth. Again, if I get back to a normal price to EBITDA of about 9, which I don't consider unreasonable, rates of return over the next couple of years could be, you know, almost tripled. I mean, what could it be? Almost 30% a year annualized. Once again, if I look at this company from a standpoint of history, the analysts have gotten the 1-year forecast within a 10% margin of error 100% of the time. They've hit it right on the numbers, and then they've only missed 22% of the time on the 2-year forecast. So this company, again, is really a function of being extremely undervalued at this time and might be something you might want to take a closer look at. Anyway, these are 6 examples of companies out of 366 potential companies in the consumer services sector that I think are attractively valued with at least a reasonable level of quality relative to credit ratings and for that matter, historical operating results. Again, I don't think there's stocks in here for, these stocks are for everybody, but there may be a stock or two in here that would be for everybody, depending on what your goals and objectives are and what you're looking at. Anyway, this is Chuck Carnival. This is the first in my series of articles on these various sectors. I'll be doing several more and showcasing more research candidates that have become attractively valued as a result of the recent recession. Thanks for watching. I look forward to presenting my next video to you. Thanks again.